All right, let's dive into JBT Marel's first big report card since that huge merger. Everyone was asking the same question. Can they actually make this work? They needed to show some real, hard, operational proof, so the big question is, did they deliver? You know, when JBT and Marel came together, it created this absolute giant in the food tech space. But mergers are messy, right? The biggest question mark hanging over this deal was simple. Would it actually work financially? Well, that first report card just dropped. And let me tell you, the answer is a big, resounding yes. So let's get right to the good stuff, the bottom line. Wall Street was expecting something around $1.28 for adjusted earnings per share. JBT Marel came in at $1.49. That's a 21-cent beat. I mean, that's not just a beat, that's a smash. It's one of the first, clearest signs that they are executing right out of the gate.
And look, it wasn't just an earnings story, which is so important. They crushed it on the top line, too. We're talking $30 million above the midpoint of their own guidance. So you've got this 1-2 punch, a powerful beat on both revenue and earnings. Just a fantastic showing.
Okay, so the numbers were great, but how did the market react? I mean, that's the real test, right? The stock popped 4.6% on the day, which is nice. But that's not the most interesting part of this chart. Look at that volume bar. It just exploded. We're talking almost 3 times the average daily volume. This tells you something really important. This wasn't just a quiet little drift up. This was the big money, the institutional players, stepping in with conviction and saying, we believe this story. So yeah, a decisive beat. No other way to put it. For investors who are on the fence, these numbers pretty much validated the entire reason for this merger in the first place. And when you lay it all out, you see just how comprehensive this was. You had the EPS beat we talked about, the revenue beat, but then you add in really strong EBITDA and, maybe most importantly, $88 million in free cash flow. It was just a powerful performance across every single key metric.
All right, so the what is clear. They crushed it. Now let's get into the how. What was actually driving these incredible results? Let's peel back the layers and look at the key operational engines here.
Okay, this right here, this is a huge piece of the puzzle and a core part of the bull case for this company. Over half, 52% of their revenue is now coming from recurring sources. Think services, parts, software. This isn't one-off equipment sales. This is stable, predictable, high-margin cash flow. It acts like a bedrock for the business, and it was, without a doubt, a key reason they were able to deliver such a strong quarter. And what about those synergies everyone was talking about? Well, they're not just a promise on a PowerPoint slide anymore. They are happening right now. They already banked $8 million in cost savings in Q2. They're on track for an $80 to $90 million run rate by the end of this year. And the long-term goal, $150 million a year. This is the merger math playing out in real time. So what do you do with all that cash flow? You pay down debt. And boy, are they doing it fast. They started this journey with a net leverage of 4 times, pretty high. But in just 2 quarters, they've already knocked that down to below 3.4. That is rapid deleveraging, and it gives them so much more financial flexibility going forward. Okay, so it wasn't all sunshine and roses. Every earnings call has a but, and for JBT Marel, that but was tariffs. This was the main headwind they discussed, but the key here is how they framed it. Not as a crisis, but as a manageable problem with a very clear plan. And they were super transparent about it. They basically said, look, we're going to feel this in the second half of the year, expect a little dip in our margins in Q3 as we absorb about $10 million of this hit. But here's the crucial part. They have a plan to get back to neutral. Through a combination of pricing actions and supply chain tweaks, they're aiming to completely offset these costs by the first half of next year. That's the light at the end of the tunnel.
But the biggest fear with tariffs isn't just the cost. It's demand destruction. Our customer is going to stop ordering. And this is where CEO Brian Deck dropped maybe the most important line in the entire call. He said, and I'm quoting here, they've seen literally 0 impact on orders on the protein side of the business. And folks, that is more than half their entire company. This one quote probably did more to calm investors' nerves than anything else.
Okay, so the numbers are strong and they're managing the headwinds. But let's zoom out. Beyond the spreadsheet, how do we know this merger is actually working on a strategic level? This is where we find that operational proof we talked about at the beginning. This slide really gets to the heart of it. The old way was transactional. You'd sell a company one machine, one component. The new way, it's about selling the whole system, the entire integrated production line. This changes the game. You're no longer just a supplier. You become a deep, strategic partner. And of course, it locks in all that juicy long-term service revenue.
And if you want proof that this is working, here it is. Just by combining their sales teams, they've already grown their sales pipeline in the North American poultry market by 15%. That's the cross-selling in action. These are the revenue synergies that investors were dreaming of, and they're already showing up, way ahead of schedule.
And for the final piece of evidence, just look at the legacy Markel business on its own. Its profit margin, the adjusted EBITDA margin, jumped by 400 basis points. I mean, that's a massive improvement in just 1 year. That is not an accident. That is the direct result of JBT coming in, applying their operational playbook, and executing on the synergy plan. It's really a textbook example of how a great integration is supposed to work.
So all in all, just a fantastic, powerful quarter. But in the market, it's always about what's next. So let's put on our analyst hat. What should we be looking for on the next call? Here's our take.
Okay, here's the breakdown. For Q3, we're not expecting any surprises. We think the results will be pretty much in line with what management guided to. Revenue kind of flat and margins down a bit because of those tariffs. But here's the interesting part. We think the stock actually drifts higher. Why? Because the market is smart. It's already priced in that temporary Q3 dip. Now the focus is shifting to the bigger picture, the synergy execution and the recovery in 2026. And that's exactly why we're slapping an outperform rating on this name.
So if you're with us on that, how might you play it? Well, one idea is a long, bullish call spread. You'd want to go out a bit in time, maybe to the first quarter of 2026, to give the story time to play out. You could look at something like the 155 by 170 strikes. Really, the whole thesis here is a bet that as those tariff headwinds disappear and the proof of synergy execution keeps piling up, the market is going to re-rate this stock higher.
And of course, we always have to say it, this is not financial advice.